Brad Thomas joins me here today. You can find what he is up to by heading over to widemoatresearch.com. We're going to be doing a REIT 101 kind of a thing today. In fact, we have a great guest for that because Brad wrote a book called REITs for Dummies.
Yeah, and this is my latest book. I have a copy here. I've written other books about real estate and REITs, but this was a really fun book to write. It's not just targeted for dummies. I know the title says that, but it's actually a very broad book, and we cover all aspects of REITs, even the global REIT market, as well as ETFs. So it's a really big part of the real estate universe and growing, and excited to talk about that here today.
Yeah, I think a lot of people, thanks to shows like mine, we have a situation of scaring people off a little bit when it comes to actually doing the heavy lifting. So they start to look at opportunities to invest a bit more passively. Could you break it down, like in a few minutes, talk a little bit about how you found your way into the REIT niche?
Yeah, sure, Jack, no problem. And so it really started with my background in the private real estate world. So I started out right out of college. Within a year or two, I bought my first home. It was a residential home, and ended up buying some rentals and some duplexes, and really loved to collect that rent. And then I ended up building some single tenant properties. These were about $1 million or so. And then I got into the shopping centers and eventually landed into the Walmart world. I started really small with rentals, and it's a great way to get started and create wealth in the private side and real property. However, one of the things I found out with the rental business specifically is that there's a lot of operational requirements, and you've got to pay the taxes, insurance, maintenance, collections. There's just a lot of things that go into rental real estate. And so what happened to me was I took a different path. I became a developer, really due to kind of a failed business partnership. It's always important to pick the right partners. And then later, due to the Great Recession, 2008, 2009, I ended up writing articles on this website called Seeking Alpha, which is still available today. Go to seekingalpha.com. And I've written thousands of articles there on real estate. Most of those are on real estate investment trusts. So the biggest differentiator for me, and I think for a lot of folks, is that when you own private real estate, you have to deal with what I call the 3 T's, the taxes, the trash, and the tenants. And with REITs, you don't have to do any of that. You basically entrust the management team to manage these properties. These are publicly traded companies, so you get SEC reporting. You get full transparency of what you're investing in, which I didn't have in my private partnerships, some of which where I didn't manage those businesses. And then, of course, one of the biggest things you have with publicly traded REITs versus private real estate is liquidity. And you get instant liquidity. If you want to sell shares in XYZ company, you can immediately get your money. And unlike when you sell a property, it takes a while. You've got to get a broker and market the property and hopefully a buyer and a bank. And eventually you create liquidity, but it takes months and months and months. So those are really the primary attributes that have led people into the real estate investment trust sector.
You have different frameworks for people, especially in this book, on how to kind of navigate into REITs like that first time. Could we start at the beginning? Like, let's talk about somebody who might be interested in this, but they frankly just don't have a good place to start. Outside of picking up your book, what do you think they should be doing?
Well, understand, I guess, a couple of the laws, and I'll highlight really, the REITs were formed in 1960. So this is nothing, it's not like crypto. These aren't new inventions. They're tangible. They're really tangible. You're investing in tangible assets. Again, they are publicly traded. Those funds are flowing into real property. And these laws were created in 1960. So it's been over 50 years of history where you can rely upon the performance of REITs in multiple market conditions, whether it's recessions or even a global pandemic. So again, for the individual or the starter investor, I would say, REITs have been around a long time. They're nothing new. The other part of that law that I want to mention is to qualify as a REIT, the company must pay out at least 90% of their taxable income to investors. Now, the reason that's important is that means you, the investor, gets a large dividend distribution from these properties. Unlike an ordinary stock or a C corporation, a lot of investors gravitate to the REIT sector because of the dividend income and the pattern of consistency and predictability and reliability for these companies. Because these are diversified portfolios. It's not like owning one property or a couple duplexes. You get many rent checks that are coming into these REITs that creates a very diversified income stream, which is extremely important, especially if you're a retiree, for example, or even a pre-retiree getting ready to retire. You depend on that income that comes in for your living expenses. So if I were going to start up from scratch, I would first say, look, this is a very broad universe of real estate. So you can invest in the primary, the core positions like residential, for example, or retail, or certainly the office sector, which we can talk on, has really been interesting thanks to COVID. But those are some of the core sectors. Or you could build a portfolio utilizing some of the specialty categories like cell towers, which really didn't exist up until around 2008 or 9, or data centers, which is certainly mission critical properties, especially as we talk about artificial intelligence today. But these data centers are the backbone of artificial intelligence. And then you can go into other healthcare sectors or subsectors like medical office buildings or skilled nursing or senior housing. You can even go into a very specialized sector, the cannabis sector, which is extremely volatile, still not federal, but certainly there's many different companies you can invest in that own cannabis properties. And then you have the net lease sector, which is the freestanding properties like Walgreens or Advance Auto Parts or FedEx, Amazon distribution centers. These are all freestanding properties. So you could build a portfolio with those companies. And those are very reliable because they're long-term contractual leases that provide very stable income for investors. In terms of retail, you could go there. I mean, I like the retail sector, especially in the US. There's been a lot of retail built over the years, but not so much lately as it relates to COVID. We really slowed down the growth in terms of new retail. But you can go really a couple of spaces there in the mall space. You can go in the outlet sectors, or you can go in the shopping center sectors. Healthcare, retail, industrial. Industrial is another category that's extremely popular. A lot of technology. In my book, REITs for Dummies, I actually write about most every property sector has some type of property technology or prop tech associated with their business model. Self-storage is another classic example of companies that have really utilized prop tech to grow their portfolios and expand their businesses. So there's a lot of different ways to invest. And so, think about it as a developer, Jack. I could never, I built shopping centers and I built, some freestanding properties, but I could have never been able to own a data center, but I can now through shares of one of the data center REITs. So there's also a new sector that opened up a couple of years ago, which is basically the casino or the gaming sector. So now you can own actually shares in a company called Beachy Properties, which owns Caesar's Palace or MGM in Las Vegas and a number of other iconic casinos across the country. So there's many ways you can invest. And I would say if I were going to start in a portfolio today, I would create, I would not just buy one REIT. I would buy, a basket or multiple REITs to maintain that diversification, but really build your basket or your portfolio around your risk tolerance levels. If you're looking for income, you may want to look at some of these net lease REITs that have long, duration contracts, as I mentioned, with very predictable income. If you're looking for growth, you may want to look at some of the technology focused real estate sectors like data centers or cell towers or logistics. I call that the tech trifecta, where you can have exposure to all three of those categories. So again, it's a great way to invest. And for the large part, these management teams are experienced, not all, but a lot of these management teams are experienced. And the best companies are the ones that are able to achieve competitive advantages, such as their cost of capital or scale advantages. So part of our research is really applied to those competitive advantages. That's why we call the firm Widemoat Research, because we like to distinguish between those companies that have really superior competitive advantages. So that's how I would start, Jack, to answer your question. And of course, we provide a lot of that research at Widemoat Research.
Yeah, I think as investors, we kind of put our blinders on. And you just rattle off a whole list, including data centers and storage facilities and industrial. I would imagine that quite a few people may not even realize that there are all these different REIT type categories.
Yeah, I mean, that's all in the book. And that's why I really dedicated a lot of this to those different categories so people could understand how to invest in those businesses. And I think certain sectors are more challenging. We can touch on office here in a second, where you've seen a lot of these urban owned properties like in New York City or San Francisco have really struggled even post COVID. But we're seeing a resurgence in Sunbelt markets. I live in South Carolina and I'm down in Florida a good bit. And you can see all of the people that have migrated from a lot of those urban areas to the South. By the way, that's another way you can build your portfolio around your geographic preferences. So if you wanted to own, say, a portfolio of, real estate in the Sunbelt markets, you could own like apartment REITs, like New America, for example, based in Nashville, but they're one of the largest Sunbelt focused apartment REITs in the country. You can also get exposure, say, to 10-year outlets, which is in Greensboro, North Carolina, but is predominantly located in Sunbelt markets with their outdoor outlet properties. So you don't want to invest in California, but you could avoid that market and invest, say, in other markets. There are a lot of companies, a lot of U.S. REITs that also invest internationally. So you could also consider some of the international exposure. There's a number of REITs that invest in Europe, in Canada, and Mexico. And so you could look at that diversification as well. You're right. I mean, there's a lot of different people aren't familiar with how to invest in these, and it's very easy. I mean, just like buying a Coca-Cola or Starbucks stock, you can buy these REITs. There are about 160 equity REITs, meaning they actually physically own these properties. We also have about 40 or so mortgage REITs. Mortgage REITs are more like banks. They invest in the loans, the basically lenders to developers or real estate owners. So when you invest in mortgage REIT, you don't have the security of that equity ownership because they're just mortgages. Overall, there's about over 200 equity and mortgage REITs in the U.S. And when you think about the market share for REITs, and I'm talking about the equity REITs that own the real estate, it represents about 10% of all institutionally owned real estate in the U.S. So if you think about it, of all those 150 equity REITs, out of all of the assets that they own, that represents about 10% of the all institutionally owned property in the U.S., which means the sector is extremely fragmented and will continue to grow over time as more and more investors pour capital into the REIT space. That number is growing significantly, thanks in part to the growing retirement base and the so-called silver tsunami of people that are moving closer and closer to retirement that are depending on that type of income for retirement. They don't have to own the real estate. They don't have to deal with the taxes, the toilets, or the trash, the 3 T's that I mentioned. They can just collect those dividends and let those management teams work for them.
Mm-hmm. So just to remind everybody, to learn a little bit more about how Brad's team can help you, head over to widemoatresearch.com, widemoatresearch.com. That's going to be a clickable link in the show notes. So Brad, you're bringing up quite a few questions here, and I'd like to spend a little time on what type of ducks do we as an investor have to get in a row before we can even consider, like, the capital? What do we need to have that was just to participate?
Sure. Well, you have to have a trading account, Charles Schwab, Fidelity, whatever institution you like. Certainly, you're going to have to transact and buy those shares just like you would any other stock. Or you could work through a financial planner. A lot of folks prefer to use their own financial planners for those stocks. Or the other alternative is an ETF. And I've got a full chapter in the REITs for Dummies book called ETFs and how ETFs operate. So those ETFs essentially are exchange traded funds where these portfolios are already built or managed by third parties. And so you don't have to research those as much as you would, say, individual stocks, because those ETFs are basically building those baskets for you. So there's a couple ways you could invest in a REIT, either through an investment advisor, through your own account, or through ETF solution. I would say the other frequent question I get is, how many REITs should I own? Or what percentage of REITs should I own in a retirement portfolio? And I would say the answer to that is it varies. And every investor has his or her own risk tolerance levels for REITs. I would say at a minimum, kind of a broad brush approach, would anywhere between 10% of your retirement portfolio to up to, say, 20% would be probably more aggressive, maybe the midpoint of 15% in REITs. And, REITs are, again, terrific for income. You're going to get higher income. Typically, over time, REITs have generated superior total returns due to other asset classes, in large part because of that dividend, the fact that these companies are continuing to grow dividends. And again, I'll go back to the historical relevance of REITs. They've gone through many different economic cycles, including, COVID-19 and the pandemic. And for the most part, they've come out of it fairly well. There were quite a few dividend cuts during that period, but they've all been built back up and are actually distributing income at a higher level than they were before COVID. So I would say, 10% exposure, those are the ways you can invest. Do research. I mean, like you would, and even if you're investing in the private real estate world, due diligence is a must, and making sure you understand the business. Like Warren Buffett always said, don't invest in business until you completely understand. And so with all of these sectors that I've mentioned, if 5 years ago, I didn't know anything about the cannabis sector, but if I'm going to recommend stocks in those sectors to investors and invest myself in cannabis, I want to make sure I know exactly what's the value proposition? What are those risks? So you always want to ask yourself about those. But really the key for me, and I think this applies to any investor who are investing in stocks, is always consider the underlying sources of income that these companies are generating and see if they're sustainable. And if the company is going to pay dividends, which again, REITs must pay out dividends, but you want to make sure that that dividend is safe, that it's reliable, the dividend's not going to get cut, because investors really are depending on that income. And I would say, again, coming back to kind of the starter kit, I would say, don't try to be too cute. Pick different sectors that are really simple to understand. I would, for example, probably avoid cannabis. Way too much volatility in the space right now. And, look, we're due for a recession anytime, and that's going to impact real estate. I'm not extremely bearish right now. I'm actually very bullish in real estate, especially in light of the fact that we got a new presidential administration that I think is going to be very positive for commercial real estate. I'm sure, Jack, you've had people in your show talking about things like 1031 exchanges and maybe depreciation. Those are extremely powerful tools for individual private investors. And you still have those same potential catalysts that exist in the REIT space. And while, say, corporate tax reform is not going to necessarily impact REITs because REITs pay out most of income to investors, I think it will benefit, individual investors and a lot of those companies that are customers to REITs. These corporations should be in a better position with corporate tax reform that's being proposed with the current President Trump's administration. I do think you're going to see an acceleration in building and construction, manufacturing in the U.S. We'll see how that plays out, but that is something we're watching very closely because that could be significant for warehouse landlords across the country as their space requirements perhaps increase as a result of some of these things going on in administration. Now, there are other areas where it may not benefit real estate. For example, the Doge, Elon Musk and the Doge team are talking about reducing government office. So if you own a government building, which there's one specifically that owns all government properties, that could be impactful. And that's a company that we're probably avoiding at this time. We also is important to look at those different factors and figure out which are the best places to invest. And certainly we're following all of that very closely here at Widemoat Research.
Yeah, well, could you dive into what people can expect if they come to Widemoat Research? What can you help them with? How does this work? Can you kind of give us a breakdown of what to expect?
Sure. Thank you, Jack. Yeah, for sure. My focus is REITs. We also cover many other different classes. They're all basically rooted in income. So think about REITs. We also cover business development companies. That's BDCs. Very similar to REITs. They have that very similar tax advantage structure in that most of their income, 90%, is paid out to investors. However, they don't invest in real estate, hence the name business development corporations. We also cover and recommend master limited partnerships. Again, very similar to REITs and BDCs, very focused on income. These are a lot of energy companies and companies that transfer energy and natural gas to their end customers. We also cover the banking sector, obviously correlated with real estate. And so that's another sector that we recommend. Asset managers, companies like Blackstone, which is the largest asset manager in the world. They own a lot of real estate, Blackstone, as well as many other asset managers. The utility sector, again, that is correlated to real estate because you've got to have power and gas and water to get to these properties. So our team covers utilities, home builders, very, very correlated to real estate and want to see those. So we've got a very broad coverage spectrum because at the end of the day, what we want to do at Widemoat Research is build a basket for the individual investor so that they can customize their investments to these various sectors that are going to perform the best over time. So that's what we do at Widemoat Research. We've assembled a world-class team of analysts to cover that very broad stock coverage.
Well, with the new administration and the current economy, we've been hearing rumblings about a recession for a long time. I think we're starting to dive into that. Whether we see the reports on the news or not, we can see some of this activity. What do you expect here regarding the economy? And is there anything in particular regarding hot markets or product right now that we should keep an eye on?
Yeah, for sure. And, I agree. I think the tariffs are certainly weighing on investors' minds right now. We've seen a lot of volatility. Trump has something to talk about every day. And so trying to decipher how that will impact investors and whether or not Trump really forces a lot of these tariffs, there's no question it's creating that volatility. Will it lead to inflation, increased inflation? And I do think some of these weather related events have certainly not helped here in my backyard, being the hurricane that came through here several months ago. That was considerable and certainly is going to have an impact in the food chain. And then you look at the West Coast and the California fires as well. So how is that going to impact valuations and really inflation across the board? So I think when you look at tariffs and some weather and just some of the economic indicators, and we cover retail, so we look really hard at consumer spending and how safe the consumer market is. And actually, the consumer market is holding up better than expected. And we're seeing that in a lot of the shopping centers and malls that we cover. I just wrote on Simon Properties recently, which is the largest, mall landlord in the world. And we're still seeing really positive signs on the consumer side. Now, kind of the lower end of the spectrum, I guess we'll call it the subprime industry. There's definitely some concern there. Look, a recession is not a bad thing. And I don't think the recession that we're talking about is going to be anything like the global financial crisis, more of a garden style variety, in my opinion. And what happens in most every recession is interest rates will come down. So, in some ways, this recession could be the best thing ever for President Trump. For one, he can blame it on the Biden administration because, it's fairly early in his administration. And secondly, I think it'll certainly get the rate cut that everyone's needed. Because as well as I do, Jack, the jet fuel for commercial real estate is rates and getting these rates down. And when you can reduce that cost of capital, it's going to definitely help a lot of people sleep well at night in commercial real estate. And especially as a lot of these loans continue to mature and are having to be repriced in this new pricing environment, that's made it very difficult for a lot of private real estate owners. So I think the recession is something we're really watching closely. And I do think we'll probably have a recession later this year, would be my guess. And that should allow President Trump to get what he wants and a lot of commercial real estate investors, and that is an interest rate reduction.
It's one of those things that, every time he opens his mouth, you don't know if it's another negotiation strategy or if we're actually going to see something materialize. So, with all of that, let's say somebody is getting into real estate and REITs for the first time. Do you have any pillars that they should consider before they invest their hard-earned money?
Absolutely. So, one of the things that's really important is to look at that historical. Again, the great thing about real estate is you have lease contracts and you can look at the historical earnings of these companies. And if the company has cut their dividend in the past significantly or have more of a chronic dividend cutting routine, then I would definitely avoid those companies. If the dividend yield is over 10%, I would always caution that because typically I call that in my book, there's a term I use called the sucker yield. And a sucker yield is simply any dividend yield that's too good to be true. So I would say be careful. I'm not saying all companies that yield over 10% are dangerous, but certainly they're not growth companies. So you want to, in my opinion, you want to be able to have companies that are going to be able to grow their dividends and sustain their dividends. So I would first rule out, kind of some of those dangerous stocks and really look at quality earnings and make sure they're able to generate quality earnings. We also look at their balance sheet, which is certainly correlated to earnings. Typically, a company that's going to generate very frequent earnings growth it's got to have a very strong balance sheet with low leverage. Now, the good thing about the Great Recession that we both lived through is that when REITs were really hurt pretty hard, like all financial stocks, banks included, in the global financial crisis. But during that time, most of the REITs have become much more, I guess, risk averse, and they have reduced their leverage. But you still want to make sure you got companies with low leverage, hopefully a investment grade, balance sheet, for example, that have the lower cost. And then you want to make sure the company's diversified. There's a company that we cover that is in the theater space, and they actually started out with just 100% of their portfolio in theaters, and they were able to diversify over time into other experiential type real estate, like Top Golf, for example. But when COVID hit, we found that they didn't diversify fast enough because their business model was really decimated as a result of the closures, the fact that theaters weren't open. And then we had an acceleration of theaters going out of business and really being troubled. So I would say diversification is really important, making sure you don't have all of your eggs in one basket with these different companies. There's a chapter I wrote in one of my books called Management Matters. And I think it's really important we spend a lot of time with our management teams, CEOs, CFOs, CIOs of all the companies that we cover, making sure that our interests are aligned with them. We like to see them have some ownership in the stock. We like to see stock buybacks if necessary. We like to see dividend increases. A dividend increase is certainly a really good signal that the management team is aligned with the individual investor. And so we try to jam on all those parts and pieces and really come up with a quality rating on the company. It's a higher quality company. And at that point, then we ask ourselves, what price should we buy it? This is probably the most important part of our research, is examining the valuation of the company to make sure that there is a desirable margin of safety between whatever we think the perceived value is of that company on a per share basis and the current share price. So we want to make sure we're buying at a discount. We don't overpay for anything. I think all of that kind of leads to where we are. And because that's what's going to create superior returns for investors if they buy, high quality merchandise or stocks when they're trading at it with a margin of safety.
You mentioned that a product like the cannabis type REITs are a bit volatile right now. Is there any of these products that are kind of a bit more steady Eddie where people would be, that's considered safer?
Yeah. And you're right. I mean, cannabis, those yields, those dividend yields are, in the 9, 10, 11, 12% range. Anytime you lend money out, in its 10, 11, 12%, you're going to get a default. That's just going to come with the territory. It's a higher risk value proposition. So again, we look at the quality. Those cannabis operators aren't as strong. There's companies that are going out of business. So one of my favorite companies is a company called Realty Income. I write about this a lot and talk about this company a lot. They're in the net lease business. They own freestanding properties. So we talk about kind of the pillars of their quality. First of all, they own over 15,000 properties in all 50 states as well as Europe. So you think about it, you got 15,000 rent checks coming in every month. Now, they don't obviously get mailed, they're electronic, but can you think about if you're a landlord and you get 15,000 monthly checks coming in, that's pretty substantial. That protects you from a lot of economic cycles. For example, during COVID, this company had exposure, and they still have exposure to theaters, but it was insignificant. They also had exposure to gyms, which is also insignificant because of that diversification. And so even during COVID, they were able to increase their earnings and grow their dividend even during that 2020, 2021 period, which is a testament to the superior diversification of the business. Second thing I like about Realty Income is their cost of capital advantage, which is extremely important. And by that, they've got an A-rated balance sheet, and most all of their debt is unsecured. So they just got a strong ability to grow their portfolio because they've got ample liquidity with a very strong balance sheet. And that creates another Widemoat advantage for the company. They're also in Europe, which is an area they've diversified and have some considerable exposure in that market. If I were going to invest, I would say looking at those pillars of scale, making sure they're diversified, can protect themselves through different market downturns, and they've got the cost of capital advantage. This particular company also pays monthly dividends. A lot of REITs, but most REITs pay quarterly. There's about a dozen REITs that do pay monthly dividends in the U.S., and Realty Income is one of those. So that one has become a real popular retirement pick because you've got a really good, attractive quality income stream, well-diversified, low cost of capital, and the dividends are paid monthly. And the last thing I'll say is Realty Income is trading at a very good discount right now. So there's that margin of safety. So you can buy the stock and at least feel pretty confident that you're not overpaying for the shares today. So I think that particular company is very attractive.
Sure. Well, this has just been such a fantastic conversation, Brad. I really appreciate you giving us a REIT 101 lesson. I want to point people to your book, which is REITs for Dummies. That's always, I'm sure you can pick that up anywhere, including your local Barnes and Noble and Amazon and everywhere else. More importantly, you might want to take a look at what Brad and his team can help you with by heading over to widemoatresearch.com, widemoatresearch.com. But before we jump into the rapid fire questions and close out this episode, Brad, is there a question or concept or anything we should have touched on we might have missed?
You mentioned funny story, Barnes and Noble. I built the Barnes and Noble here in my hometown. My book was there up until about 2 weeks ago when they closed. I think I built that building 25 years ago. And when I built the building, I was just a little scrappy developer and I had no clue that my book would be in the store. I've done a couple of book signings at some other Barnes and Nobles. And unfortunately, this one's closed. You'll have to go to the closest one, or of course, as you pointed out, Amazon.
Yeah, it has to be kind of, doesn't it, walking into a bookstore and seeing your book sitting there?
Yeah, I tell people a lot. I made my living in real property, building real property, and then I transitioned to intellectual property. It's hard writing books. You have to be very disciplined and focused, but I'm ready to write another one now. A lot of fun doing book signings, especially the one that I built.
Well, if you're ready, we'll jump into the rapid fire questions and close out this episode.
Let's do it.
Well, the first one is, what lie do real estate investors often tell themselves?
Oh, man, that is a good question. I would say that you're worth more than you actually are. And that led me to another book that I wrote. My first book was called The Trump Factor. And I met in 2013, at the time he was not president, of course, Donald Trump. And he would talk about his net worth. And then I met him again and he would talk about his net worth. And I think it was the fourth or fifth meeting. I walked into his office and I said, Mr. Trump, we're not going to talk about, real estate today. I'm writing a book and I'm going to show you in the world what your net worth really is. And that was my very first book.
How did he respond to that?
I ended up becoming an advisor for the president and his first administration. We became very close personal friends. And that is what's surreal. How did a small-time developer from South Carolina become friends with the president of the United States?
So would you mind me asking then, based on how you know him and what we're seeing right now, I don't know, kind of think that this is unprecedented, the amount of activity we've been seeing over the past couple of weeks.
Well, there's a mandate, and he's given everybody exactly what they wanted and who voted for him. I think it's definitely different. I was there in the first regime. It's totally different. He's a lot more experienced. He's had 4 years to think through this, and he's putting all that to work as we speak. Whether you agree or not, he is definitely right. I just don't understand. I've been around him a good bit, not as much recently, but certainly in the past. And I just don't understand how does he sleep at night? I've never seen anybody work so hard in my life. And I saw it when he was building buildings and buying properties and building his multi-billion-dollar, real estate empire. And I just need, you just cannot outwork him whatsoever. So yeah, it's been interesting to watch. And, I'm excited just for all Americans over the next 4 years. I hope this brings a lot of prosperity to Americans, and I think it will.
Yeah, he seems like he's working at such a rapid pace. It's almost like the media can't keep up with it. It's just been an interesting situation. If you could go back in time and give your younger self a piece of advice, what would it be?
That's a good question. These rapid fires means I'm not prepared.
Well, that's the point of them too.
You just enjoy life. I mean, just enjoy life. Days by so fast. I've got 5 children, and they're actually not children now. They're virtual adults. My oldest is in high school, senior in high school. But I mean, it just goes by so fast. And I think the best advice is just take everything day to day and enjoy life. Time flies.
I can't emphasize that enough. My daughter just graduated high school, and it feels like yesterday where she was just in braids. It happened so fast. Do you have, outside of your own book, do you have a book recommendation, or what are you reading right now?
Let's see. Actually, I got Elon Musk sitting here. I'll tell you the book that I recommend to a lot of people, and I've read this multiple times, but this is right. This is the best business book you'll ever read. The Intelligent Investor. Now, my book is called The Intelligent Reinvestor. One of my books is The Intelligent Reinvestor. But I purposely named my book that because this is Benjamin Graham. Benjamin was the Warren Buffett's mentor and business partner. And I talked a lot about previously here just about the margin of safety and buying high quality companies and at a discount. And it's all in this book. This is what he wrote about. And I think this is a must read book for REIT investors. As far as right now, I'm actually sitting right here on my camera, but I haven't started it. Fooling some of the people all of the time. This is David Einhorn. This is an interesting book. Because of this book, he ended up creating a business, a company that's publicly traded. And I'm actually covering that business right now. So I'm anxious to read this book because it's because of this book that he ended up founding this company that I'm researching.
Oh, interesting. And then finally, what single strategy or tool have you implemented that has had the biggest time-saving impact to you or your business?
Yeah, so there's a company called Fast Graphs, founded by a friend of mine, Chuck Corneville. Fast Graphs stands for Fundamental Analysis Software Tool. So if you're a stock investor, you can be a REIT investor, a C Corp investor, a BDC investor, but if you just buy stocks, Fast Graphs is the best tool that I've ever found that is able to identify and screen for companies to buy, utilizing a lot of those fundamentals that I just mentioned here, looking at earnings and dividends and forecasts and balance sheets. It's a quick way. So if you would ask me, like if I did a rapid fire and I said, hey, would you buy shares in Coca-Cola? I would go to Fast Graphs. I'd type in the ticker symbol for Coca-Cola, which is KO. It would show me it right there within 15 seconds. I could look at that chart and see if it had all of the ingredients that would allow me to be able to buy that company, including the price and valuation and all the fundamentals. So Fast Graphs and Chuck Corneville, they're based in Tampa, but you can go to that website, fastgraphs.com. It's a great tool.
Well, Brad, this was fantastic. One last time, you can find more information at widemoatresearch.com. Clickable link in the show notes.
You bet. It's good to see you, and let's do it again sometime.